We're interviewing some of the top minds in economics to get a sense of what's next for the global economy and financial markets. Today we're talking to Mohamed El-Erian. He's the Chief Economic Advisor at Allianz and the former CEO of PIMCO. Mohamed, thank you so much for joining us today. I want to start out with your outlook for the economy overall. How long is it going to take for the global economy to get back to normal?
If we don't get specific policies that we can talk about, it will be a long and rather flattish recovery. And we have to understand that we're going to come from levels that will still be eye-popping, notwithstanding really horrible numbers we've seen so far. So we are going to be in a very deep hole. And unless we get policy accelerators, it will take us quite a long time to get out of it.
Are there parts of the economy that you think might never return to what we would see as normal?
So there are going to be a very wide range of winners and losers in this economy, not only among companies, but also, unfortunately, among people, with the most vulnerable segment being most at risk.
So let's talk about some of the policies that are necessary then to try to address that inequality.
You've got to address productivity. It's about infrastructure. It's about retooling and retraining of labor. You've got to address household economic insecurity. It's about better safety nets. And then you've got to do something about globalization. It's one thing to deglobalize. It's another thing to deglobalize in a disorderly fashion.
What are some of the factors that might keep the unemployment rate at that high level, given that we were at 3.5% just in February of this year earlier?
So I think part of it is companies not coming back. We're going to have, unfortunately, lots of bankruptcies. Once a liquidity problem becomes a solvency problem, you cannot reverse it that quickly. Certain activities that happen to be very labor intensive, hospitality is very labor intensive, are not coming back. Then you have existing companies that are now no longer talking about resizing, they're talking about right sizing. And most of them, unfortunately, right sizing means less labor. So existing companies will also be shedding labor. And then the sectors that are going to be really favored in the next couple of years, other than healthcare, are not that labor intensive. So I worry that what started out as furloughs, now becoming short-term unemployment, may become long-term unemployment and the people dropping out of the labor force. And that is problematic both for the supply side and the demand side. That's why I keep on saying it's really important to identify likely trends and do something about them now, because none of this is predestined. We have the tools to address these things, but we have to change our mindset.
So the Fed has tried to address some of the demand side with rates at zero and these trillions of dollars in stimulus. Is this the Fed's job to continue trying to stimulate the economy going forward?
It is certainly not the Fed's job. In fact, if the Fed continues doing what it's doing, it will become a big part of the problem. All that the Fed can do is ensure financial conditions that encourage risk-taking, encourage companies to borrow. Why? The hope that the more risk we take, we boost up asset prices. The more we boost up asset prices, the better off we feel. And the better off we feel, the more we consume. The wealth effect. And then on the other side, the hope is by making bond financing really cheap, it will encourage companies to borrow in order to invest. But what we've discovered is that when that happens and the underlying economy is not fixed, companies borrow for debt buybacks, for stock buybacks. They borrow for financial engineering, basically. And people take on too much risk. And you don't get to the real economy. So you boost asset prices, you boost debt, you boost everything financial, but you don't get to the real economy. That is, I stress, that is the way that the Fed is constructed. It can only go through asset markets. So you need entities that can actually address underlying productivity and underlying demand.
And that would be Congress or state governments, or where would that kind of come in then? Whose job would that fall to?
So all of the above. It is local government, it is state government, it is the federal government. It is also collaboration with other countries. Even though we're going to deglobalize, it doesn't mean we're going to turn linkages with the rest of the world off completely. We're still going to have supply and demand linkages. There'll be less pronounced that they are now. And it's also companies' role. I think one element coming out of this crisis is greater social responsibility and companies realizing that they have a role to play in making sure that we have more inclusive capitalism.
You've talked about the disconnect that we've seen in the real economy and the financial markets. Is that primarily because of the Fed? Are there other factors at play? And how can the average American understand why the stock market is booming while there are 40 million people who don't have jobs right now?
Yeah, I mean, it's something that's actually hard to explain. I get asked that question all the time. And the easy answer is the markets are not the economy. But then people press you, but aren't you investing in companies? And don't companies operate in the economy? And you say yes. And then the next easy answer is, well, markets are forward-looking. They can look through short-term. So yes, unemployment is terrible, but that's short-term. Markets are forward-looking. And then you get a really interesting answer. You say, so let me get this right. Market analysts confidently predict what the future looks like when most companies have suspended earnings. So most companies are telling investors, we don't have visibility. And then, but the people who call the market seem to have perfect visibility. What's going on? How can that happen? Which leads you to the third answer. It's not about companies. It's not about the economy. It's about a backstop. It's about confidence that someone with a printing press in the basement, massive willingness and ability to support financial markets, as they have done for the last 10 years, will continue to do so. So if you're an investor who's willing to embrace this moral hazard, if you embrace it, you end up with this win-win mindset. I win if I guess correctly about the economic recovery, and I still win if I guess wrong because I'm going to be bailed out. And the minute the Fed went into the high yield market and the Fed said, I'm willing to take on default risk, I'm willing to take on capital impairments. In the marketplace, the difference between high yield and equities in the capital structure is not that big. So the mentality of the market is, well, if they're willing to do high yield, they'll be willing to do equities. Because after all, the last thing the Fed wants is a financial crisis to make the economy worse. So the market feels very strongly that it basically is holding the Fed hostage.
One of the effects of all of this, of course, is record high debt levels that we've seen growing at a record pace. Is this something investors should be worried about right now? It seems like we're kind of all ignoring it for the time being.
Yeah, it's record high debt levels with record low risk spreads and record high risk taking on part of the investors. Normally, the higher the debt goes, the more the market prices the sovereign or the company as a higher risk. But the complete opposite has occurred. Now, if you are a short-term economist or investor, say that's wonderful. The Fed has secured the loosest financial conditions on record. And if companies can borrow, they can ensure that liquidity problems don't become solvency problems.
Some companies are also then taking on a lot of debt, and we've heard this term zombie companies. So they have all this debt that they won't be able to pay off, but they continue to operate and function in sort of like a zombie would, I suppose. Is that something we should be worried about? Is that a issue for the broader economy going forward?
So I think we should be worried not just about zombie companies, but zombie markets. Zombie markets are markets that are completely mispriced. They're completely distorted. Why? Because there is a policy view that you need to subsidize everything in markets for now. So what happens when you get these conditions? The two most important roles that markets play, and we are a market-based system, and part of the success of America is the market system. One, they allocate resources. So think of the stock market. You allocate uses of funds with sources of funds. And if you price that well, you get an efficient outcome. So the first thing you do is you destroy the efficient allocation of capital across the country. The second thing you do is you destroy the price signaling. So people no longer care about fundamentals.
Does the globalization piece fall on the companies then? Because companies are seemingly the ones who are saying, we're going to try to move our supply chains back. They are getting pressure from people in Washington to do so as well. So whose job is it to try to address the fallout and how to make that even happen in the first place?
So what makes this distinct is that all three segments of society will be pushing for deglobalization: governments, companies, and households. This is very different from the first two shocks to globalization. The first in 2010 was a household-led shock. If you remember, it was led by people who felt alienated and marginalized by globalization. The second shock to globalization came in 2017-18. That was a government-led shock. This one is going to involve companies, like you just said, governments as well. We're going to have a massive blame game. Governments are going to be very keen in certain priority sector onshoring their supply. What you're going to hear over and over again is we need to localize our supply chains. And then households. I fear that unemployment may be 10% still by the end of the year. That is not an environment where the household sector embraces globalization. So what makes this different is that every segment of society will be a driver of deglobalization.
And what do you see as the biggest risk to the global economy going forward in the next 6 months and then maybe in the longer term too?
So I think the next 6 months is going to be lack of synchronization. It's hard enough restarting an economy. When I warned on CNBC in the beginning of February that this is really serious, is because I had experienced economic sudden stops, because I worked on Sudan, a failing economy at the time in the 80s. And what you learn when you get an economic sudden stop, not a financial sudden stop, an economic sudden stop is really hard to get out of. Believe it or not, financial sudden stops that seem worse are actually easy to get out of, because you can restart the financial system by using the central bank's balance sheet. Because ultimately, if financial systems break down because of counterparty risk, two banks not trusting each other. So it's like a heart attack. It hits you hard, but you know exactly where to go. An economic sudden stop is like you having infections all over your body. And you need to address these things in a synchronized manner. So look at the difficulty of your reopening when you don't have your inventory, when you're not sure whether your customers are coming in or not. Right? It's very hard. You need a certain amount of synchronization. Now imagine that you get a global economic stop. That degree of difficulty becomes even higher. So what I worry about on the economic front over the next 6 months is that we will try to reopen, but we will reopen in this desynchronized fashion and then risk all sorts of unintended consequences.
And any bright spots that you see to end on a more optimistic note?
Oh, there's many bright spots. And that's why I told you I have a sheet of paper here, because one of the challenges of winning the peace is to bottle up the good stuff we're seeing and use it. So we are seeing, for example, much more respect for science, a leapfrogging of scientific inventions that are going to help multiple generations. We are seeing better public-private partnerships. We are seeing industries, pharma, finance, technology come together and try to solve societal issues. We are seeing great acts of kindness. We are seeing much more respect for critical parts of our economy. So there are lots of good things that we are seeing in this crisis. And I think our challenge is to bottle this up and make sure it continues to help us, because it's about winning the war and winning the peace. And we've got to do it both. We can't afford a repeat of 2008.